welcome to our second masterclass at Preventable Surprises. I'm super excited that we have Denise Hearn come and share her latest research focusing on monopoly power, and that we're able to bring this into the stakeholder ESG, responsible capitalism, pick your acronym, conversation. For those who do not know Denise, I think my shorthand description is overall interesting thinker, and so it's always been a pleasure to listen to her, to read her. She has a great newsletter, great research, great books. She's an advisor and author, a project catalyzer. She's a senior fellow at the American Economic Liberties Project and a co-lead of the Access to Markets Initiative. She co-authored a wonderful book called The Myth of Capitalism, Monopolies and the Death of Competition, which was one of the Financial Times best books of 2018. And she currently writes the Embodied Economics newsletter, and she's an advisory board chair of the Pre-Distribution Initiative. I do encourage everyone to look up these various initiatives and projects. I will now stop talking for an extended period of time, and Denise, it's wonderful to have you. The floor is all yours.
Oh, thank you so much, Jerome. It's always lovely to be with you, and really excited to be here with everyone. I hate hearing the sound of my own voice for 40 minutes. So I would love if you have questions or thoughts or pushback or whatever throughout this presentation, I would love to hear from you. You can either feel free to interrupt me and go off mute, or pop something in the chat, and I'll try to monitor that as we're going along as well. And I did want to say that this paper, woo, finally came out this morning. We've been working on it for a long time, and it always feels like, I don't have any children, but it's like a little small birth into the world. And so we've got the link. I think, Jerome, if you wouldn't mind posting that in the chat for everyone. There's an executive summary for those that don't want to read 43 pages. That's only 4 pages. And I'm going to try to walk through what Michelle Meager and I, who was my co-author on this paper, are trying to articulate. And so I think that's all the preamble I'm going to do, but this is just to say that this is a joint publication between the American Economic Liberties Project and the Balanced Economy Project, which is a new organization based in Europe that's trying to coalesce the anti-monopoly movement there. And Michelle Meager co-founded it with Nick Shaxton, who's a fantastic journalist. Okay, let's get going here. So in November 2021, the US Chamber of Commerce, which was financed in part by Google, launched a fairly publicized war on the Federal Trade Commission, which is, of course, the key enforcer in fair market dealing, and Lena Khan, who's the new chair. The CEO of the Chamber of Commerce, the president and CEO said, it feels to the business community that the FTC has gone to war against us, and we have to go to war back. So this war includes, political lobbying, filing records requests and lawsuits, launching expensive PR and advertising campaigns. And this, of course, isn't an isolated event. Google or Alphabet regularly spends millions of dollars to influence politicians and shape regulatory actions globally, as do most large firms. And perhaps in part, they launched this attack against the FTC because Google is currently being sued by dozens of state attorneys general for violating its dominant position in search. And it's previously paid record antitrust violation fees for violating children's privacy laws. So we have that going on at the same time that Google, in its code of conduct, says that it pledges itself to the highest possible standards of ethical business conduct. And it's number 1 on Just Capital's list of the most just companies in America. Moving on to Amazon. Amazon is a Business Roundtable signatory. This was fascinating to me just recently. It now receives most of its revenue, the majority of its revenue, from seller fees. So that's even higher than AWS. And those seller fees can include the advertising that sellers have to pay to get visibly seen on the platform. and other fees that it's charging. And if you look over time, the cut that Amazon is taking from its third-party suppliers has risen every year. And, it's in this dominant position where the businesses that sell on Amazon are essentially economically dependent upon it, because it's the largest, most consumers start, I think it's 60% of consumers start their online searches on Amazon now. We also know that Amazon has been doing some union busting tactics over the last number of years, and other things that are not necessarily in alignment with the Business Roundtable statement that it signed. We also have Mark Benioff, who is sort of stakeholder capitalism's poster child. He recently tweeted this tweet, capitalism as we have known it is dead, and the obsession that we have with maximizing profits for shareholders alone has led to incredible inequality and a planetary emergency. When we serve all stakeholders, business is the greatest platform for change, heart emoji. And what I thought was funny about this was that his pinned tweet on Twitter, so he's saying here, okay, maximizing profits for shareholders, is not the answer. And yet the pinned tweet that he has on Twitter is this: look at our growth over the last number of years and how it's risen every single year. And the other thing about Salesforce is that they are far and away the leader in global customer relationship management software, CRM software. They capture 20% of all global CRM spending, which is more than Oracle, SAP, Microsoft, and Adobe combined. And over the last 2 decades, they have acquired more than 60 companies, some of which were mega mergers, mega acquisitions. They acquired Slack for 27.7 billion in 2020, Tableau for 15.3 billion in 2019, MuleSoft for 6.5 billion in 2018. And so, with all of these things here, the other thing I was going to say about Salesforce, which was interesting, is that in 2016, when Microsoft bought LinkedIn, they had also made a bid for LinkedIn. Benioff was, complaining to regulators, saying it's anti-competitive for, Microsoft to purchase LinkedIn. He was urging the EU Commission and the FTC to scrutinize the deal. And yet, of course, he doesn't want the same kind of scrutiny applied to the deals that he's making. So it's something of a paradox that the leading firms embraced by stakeholder capitalism, proponents, one, use lobbying muscle to subvert the ultimate stakeholder, which is the public, by distorting democracy, as in Google's case. They squeeze suppliers and workers, as in Amazon's case, and they say that profit maximization should be replaced by higher values, but they continue to acquire competitors in mega acquisitions to build competitive moats in pursuit of perpetually higher growth. So there's a deep tension here between firms that seek to do good and firms that seek power, and whether those two things can be reconciled. These companies and many other, I'm picking on tech firms, but there are plenty of others to pick on. They operate as gatekeepers in markets, and they occupy very powerful positions that they can exploit to the detriment of stakeholders. So, how do we kind of square this circle? Two movements have risen at the same time. The stakeholder capitalism movement, they've been incredibly effective at frontlining their narrative and their agenda, as well as the anti-monopoly movement has sort of burst into the public consciousness of something that used to be, for policy wonks and economists and sort of, highly trained lawyers, things like that. Now, antitrust is something that more and more people are starting to understand and recognize the importance of. I would say that, and I would say that, like, despite both of these communities and movements asking pretty fundamental questions about the nature and obligations of firms and society, the conversations in the communities don't really intersect. And so our aim with this paper is, twofold. One, it's to bring this conversation together and that the communities could learn from each other. And two, it's also to challenge some of, some folks in the stakeholder capitalism community for which it feels as though the rubber isn't quite meeting the road. And because of that, I would say that within each of these communities, there are sort of two, to oversimplify, there's sort of like two main threads of people and initiatives. So in stakeholder capitalism, there are sincere challengers to neoliberalism who are advocating for more democratic systems by sharing and decentralizing power through systemic reforms for various stakeholders. And then, there are others who are perhaps using stakeholder capitalism as a tactic to forestall regulatory intervention, to retain the private regulatory power that dominant firms now exercise in many areas of the economy. And similarly, with anti-monopoly, there are sort of two camps. There are sincere challengers to concentrated corporate and financial power and its abuses. These I would name as structuralists, or sometimes they're called neo-Grandisians. So they're trying to reassert the original kind of zeitgeist of anti-monopoly law, which is to challenge corporate power. And then there are others who use antitrust to retain the status quo, who use things like the consumer welfare standard, the efficiency defense as legal cover to basically give to wave through monopolization across the economy. So and these are, again, like very oversimplifications of what's happening in both communities and both movements. But I just wanted to make this clear, because when I say stakeholder capitalism, it's now a very wide tent. There's a lot of people who may identify or may not under that banner, and they may have different interpretations of what that means. And similarly with the anti-monopoly community. And so in that regard, just to kind of help know where I'm coming from in this conversation, I wanted to kind of define these terms, recognizing that, Allison Taylor, who's a friend of mine, she runs Ethical Systems. She had a great post recently, actually, and she's worked with Jerome quite a bit. You two have a fantastic podcast. She said the other day, when you say ESG, you can't actually say ESG and have it be meaningful, because it's such a nebulous concept and community, and there's such a range of different ways that it's applied, that there's no sort of singular monolithic ESG that you can put on the table and analyze effectively. And I would say the same thing for all of these terms. But in general, we're defining stakeholder capitalism as sort of businesses, investors, corporate scholars who are agitating under the banner of responsible business. And broadly, that they want to achieve social outcomes through the corporate sector, both with and without the state's support. But they tend to favor the tools of private capital and corporate influence through financial incentives, tweaks to corporate governments, and sometimes this is implemented through sort of, voluntary corporate initiatives, self-regulation, market mechanisms. ESG, more investors are identifying as universal owners via their mutual funds. They're collaborating to raise ESG standards of their portfolio companies, with the theory that that's going to be more profitable in the long term. The main difference conceptually between ESG and stakeholder capitalism is obviously, by definition, ESG supports the use of shareholder power to create systems change, but increasingly, self-professed stakeholder capitalists, even though they rhetorically de-emphasize shareholder primacy, they often are proposing solutions which involve shareholder engagement, or Larry Fink, considers him a stakeholder, or considers himself a stakeholder capitalist. So there's like a bit of a tension there. And then anti-monopolists, rhetorically align with stakeholder capitalism on things like workers' rights and poverty, but they differ in the analysis of the cause of those things. So that's not only profit maximization, but it's specifically the corporate abuses of power and a structural imbalance of power within the economy. And so they're advocating for enforcement of anti-monopoly laws and other sector-specific regulations that challenge that power directly. I hope that's helpful. Okay, moving right along. I haven't checked the chat. Should I check the chat? What's going on in there? Keep it rolling. Okay. Jerome, you can wave at me if you see something. So these two movements, have come onto the scene because we now live in an age where concentration is rampant across the economy. So 70% of corporations control 70% of the beer that Americans drink. And I'm sorry that this is also so US focused, but that is the majority of where I spend my time. I'm also Canadian. I do some work there. But just a caveat that, yeah, this is unfortunately a little bit US centric. So 2 corporations control 70% of the beer. We've got 5 banks that control half of the nation's banking assets, and 75% of households with high-speed internet are serviced by one single provider. So they're dealing with a monopolist. It's not just tech, it's everywhere. This is a busy slide, but we'll send the slides out after and you can take a look at some of these things. Everything from beef to funeral services to cheerleading to pool supply companies to professional grade cleaning chemicals. Everywhere you look in the economy, we are now in a situation where fewer and fewer large players dominate the entire sector. And headline numbers are also sometimes misleading. It's difficult to comprehend how uncompetitive the US economy is unless you go industry by industry. And even then, it's worse than it appears because they often can be regional or even local monopolies. And so that, when you look there, you start to see that the lack of choices that consumers have is quite severe. And the question that, we're interested in is, what are the effects of all of this concentration? So there are many, and they're increasingly well documented. And we're going to kind of skim through this because a lot of us are familiar with this, but I did want to make sure to include it for those that may not be. Things like lower wages, higher inequality, higher consumer prices, lower productive investment, less business dynamism, lower firm exit and entry rates, less innovation, lower growth, fragile supply chains, political capture, national security risks, subversion of democracy. So I'm going to go through just a few things here. Markups and higher consumer prices. Obviously, we're in the age of inflation. But this was sort of well underway before we had this huge surge in inflation. In 1980, the average markup, so that's the amount that a company charges above its marginal cost of production, was about 20%. Today, it's closer to 60%. And markups are generally a indication of market power of the firm, because if it was truly competitive, markups would essentially be zero or just above zero, right? Because they would charge just enough to be able to compete credibly with the price of their goods. As they can charge higher and higher markups, it's an indication that they don't have a lot of competition in the market. So therefore, consumers are paying higher prices. There's lower investment in concentrated industries. So you can see the chart on the left, the ratio of corporate net investment to capital has been on the decline since the 1970s. Broadly as a trend. But this chart on the right is really interesting, which shows that, and this is from Thomas Philippon, who's a fantastic researcher in New York, who shows that the investment gap is much higher for firms that are in the top 10 most concentrated industries. So that's the light gray line. You can see that as industries get more highly concentrated, they tend to invest less and relative to their valuations. And it's actually 20% lower in concentrated industries. Less innovation. So this is like a great site called Killed by Google, and it lists all the different projects. They might have been projects that were acquired. They may have been internal projects that eventually got killed off because they weren't core to the business model. And it kind of shows you, here there's listed 266 different initiatives, projects that ended up just getting shelved because, maybe they weren't profitable. And it's kind of this idea of a catch and kill M&A, where companies may acquire a firm and then just because it's, maybe a competitive threat, and then they may just shelve it because it's not worth it for them to commercialize it because they have much easier paths to profit than actually trying to innovate for consumers. There's a new IMF report that shows, or I guess it's not new, I'm sorry, I'm losing all track of time. It's a year old, but the IMF report shows that competing firms are hurt when a market leader engages in more M&A. And so they're saying that, like, if you're in an industry and your competitor starts doing a bunch of M&A, then you actually invest less in R&D and in your own investment. And so they're saying that this evidence suggests that M&A can broadly act as a drag on growth, especially when it involves dominant firms. Lower business dynamism. So entrepreneurship rates are historically low. COVID did boost these numbers somewhat as people started their own businesses. But the general trend is that it's been trending downwards for many decades. Firm exit and entry rates are declining. And this is concerning because new firms are where we get innovation. It's where you get turnover in the economy. New firms tend to employ more workers than older ones, things like that. And so these broad trends are concerning. You can see the annual rate of firm entry and exit on the left there. So fewer companies, IPOing. That's an old chart. I mean, obviously we've had a bump in IPOs recently, but again, historically not as high. New firms are playing a decreasing role in the economy, and older firms now account for a large amount of the activity, those two charts there. And part of this is because, the most dominant companies have been really successful at either vertically integrating through the supply chain or horizontally expanding into sort of ever increasing numbers of industries, which leaves less room for competitors. And you hear VCs say that they're less interested in investing in a company that may compete with, I don't know, Facebook, Google, or even any industry, agriculture, the big four meat packers or whatever, because the barriers to entry are so high, and that they know that it's going to be incredibly difficult to supplant the existing companies. I see a few more things percolating in the chat. Jerome, don't be afraid to interrupt me. For some reason, I'm having trouble actually seeing it. Lower.
Let's maybe let's take one question that came from George Kitchen, which is very timely. I think the share of firms owned by private equity is increasing, which reduces oversight of firm behavior and market share. What's your opinion on this trend? And setting aside private equity, I'm also thinking about taking private and what's happening with Twitter at the moment. So, timely question.
Yes, absolutely. Great question. Yes, someone actually said to me yesterday that there were some conversations happening where, because antitrust enforcement is ramping up, some of the existing players that could have been at the table to buy Twitter, like Salesforce or Google or somebody, and it might have made sense to them, that they didn't. I have no idea if that's true. But I think that's interesting. And I think that it does point to this idea that it's true. I think there's now double the amount of companies controlled by private equity as there are public companies in the US. And this is concerning to me because, and obviously institutional investors who have been starved for yield with low interest rates have poured a lot of money into private equity over the last number of years. And this has helped fuel the growth of it. I'm actually writing another paper right now about serial acquisitions, a lot of which happen through private equity roll-ups of particular industries. And so you're seeing this with like emergency medicine or veterinary practices, or even third-party sellers. Now you're getting VCs investing in startups, and their entire raison d'etre is to, forgive my horrible French, Jerome, but is to aggregate third-party sellers on Amazon. And, I do find this concerning because, again, when you look at the effects of this concentration, yes, sometimes the roll-up of disaggregated industries can be more efficient. And sometimes right now we're experiencing a silver tsunami where a lot of people who own businesses are retiring, and maybe they don't want to pass it on to their children. So it is a good exit opportunity for them. But, again, these aggregate trends really have perverse outcomes across the economy. And I mean, private equity is rolling up mobile homes, and then they're charging, rent to the people there and jacking up the rent. And I mean, profits have to come from somewhere. And this brings me to Jan Eekhout's fantastic book, The Profit Paradox, which is he's saying high profits may not actually be good for the economy overall if they're gained through the exercise of market power alone. Because they can act as a drag on growth, as I've pointed out, that and this is what's known as the fallacy of composition. What's good for you, or what's good for one individual actor, may not be good for the whole economy. So the classic example is a bank run. If you think the bank is going to go insolvent, you run to the bank, you try to get your cash out as fast as possible, but everybody does that in their own self-interest. And then you actually collectively precipitate the bank going insolvent. And it's the exact outcome you don't want. And this is kind of happening where, when we try to maximize the profit of one firm, and every firm in the economy is trying to do that, and they're doing so in ways that increasingly are not based on necessarily on innovation, but increasingly on the exercise of market power, squeezing workers, squeezing suppliers, et cetera. That overall is going to make the economy less productive. It's going to drag on growth. It's going to limit innovation, which then has this reflexive characteristic back to investors where your returns are going to be lower. So it's kind of like, it's a strange thing to try to tease out. And there are some stats. Yan in his book says that global GDP is about 9 to 10% lower, which is about 8 trillion less than it would be if we had the competitiveness of 1980. I hope that kind of answered the question, but I'm happy to talk more about that later. Workers are also falling behind. So for decades, the labor share was 2/3 of GDP, but in 1980, the labor share began to decline from 65 to 66% of GDP to about 58 to 59, which was 7% decline. And overall, that's around 6 trillion less going to workers every single year. You can see on the chart on the right that corporate profits as a percent of GDP have been rising and then the labor share falling. And so you have this increasing inequality between those two parties, between capital owners, and increasingly, obviously, corporate executives are compensated, in ways that sort of align with this, and then wage earners who don't share in those same profits. And there's actually a really excellent new Brookings report that just came out this week, and it's called As Profits in the Pandemic, as Shareholder Wealth-Stored Workers Were Left Behind. And what they do, which is brilliant, is they actually look at a range of companies, 22 in particular, that many of whom signed the Business Roundtable statement on to become stakeholder capitalism firms. And they say that the pandemic test revealed that the system really didn't change, that overwhelmingly it still benefited shareholders, executives, and billionaire heirs and founders. And their conclusion was that meaningful change is unlikely to come from corporations themselves, whose executives are deeply incentivized to preserve the current system. So they show here that these companies, many of whom signed, Costco is one of my faves. They didn't sign the BRT, and yet they continue to just be an ethical company based on their own, desire. They don't need to sign the BRT to do that, and they are one of the only companies that actually pays a living wage to their employees. Okay, how are we doing? This is a lot. Thank you for being here. Jerome?
No, I was just saying we're doing great.
Okay, perfect. The last thing I just want to say is that, and sorry this is so wordy, but the monopsony power affecting workers and suppliers. So typically when we hear the word monopsony, we think of it affecting workers, and monopsony is when there's one buyer. So in this case, the buyer of labor. It also can it can affect suppliers. If there's one or just a few buyers buying a product, that means that the bargaining position of those suppliers is relatively weak relative to, the dominant company. And we're seeing that more and more, especially with a project that we're working on called Access to Markets, where we speak to entrepreneurs in every industry imaginable: farmers, pharmacists, independent pharmacists, musicians, et cetera. And they all, talk about these dynamics that they're experiencing. And so you can see that, for workers, bargaining power is weakening across the board. You've got more than half of US labor markets are highly concentrated. This can drive down wages. There's an increase in things like mandatory arbitration clauses in employment contracts. There are, non-competes. A lot of workers were covered by non-competes. There's been a lot of movement around that, which is fantastic. Also, some great work by investors actually on mandatory arbitration clauses, although they specifically narrowed in on sexual abuse or misconduct cases and getting rid of that. But mandatory arbitration still exists for a lot of other harms that employees are facing. General decline of unions, precarious work situations, increasing contract work without benefits. So as as firms have concentrated and the power of corporations has increased, worker bargaining power has really decreased, as well as for suppliers and third-party sellers. We saw recently the Etsy strike, where they were upset that Etsy was raising the commissions it was going to charge on sales. We've seen the Apple and Google App Store commission developers take on Apple and Google, asking them to lower the commission rates in the App Store from 30 to 15%. I love this. While this is all happening, Meta just comes out and says, you know what, we don't really care about all of that. We're going to charge 47.5% on all digital assets sold in the metaverse. That is a huge toll. I mean, that is insane that they're going to take almost 50% of any digital asset sold. That is what's called a gatekeeper, and that they can charge whatever they want and people just have to accept it. Again, we talked about Amazon's $31 billion in revenue from seller fees. We've also seen in Canada and elsewhere, grocery store suppliers being charged compliance fees for late deliveries, even though there's been all these, horrific supply chain issues that they've had to deal with. And so they've been complaining about the dominant power of the retail grocery stores. So all of this to say that these issues are fairly profound and stakeholder capitalism ignores them completely. And, we think that this is a major blind spot for the most part. They don't ignore it completely, but for the most part. Where do investors sit with this? Let's take a look at ESG funds. So here's BlackRock's US Carbon Transition Readiness ETF, which at the time I think was like the largest raise ever for an ETF. Top 10 holdings: Apple, Microsoft, Amazon, Tesla, Alphabet, United Health Group, Alphabet, Coca-Cola, PepsiCo, Johnson & Johnson. Here's iShares, very similar. They got Texas Instruments in there, which is also fun. They've got a calculator monopoly, still going strong. We probably all had those when we were in high school. And then Vanguard's FTSE social index here: Apple, Microsoft, Alphabet, Amazon, Tesla, NVIDIA, Meta, United Health Group, JP Morgan. So, ESG investors are essentially concentrating their investments in a handful of tech companies, which has two main problems. One, tech companies don't employ many people actually relative to other industries. So if ESG investors care about the middle class, this is something to be cognizant of. Based on the holdings of the 20 largest ESG ETFs, the 15 most popular stocks with ESG funds employ just 1.9 million workers against the most underrepresented stocks, which employ about 5 million workers. Also, tech firms tend to employ significant amount of contract workers. So, Google is more than 50% contract workers. These workers have lower pay, fewer, if any, benefits. Small companies, which cumulatively the vast majority of they employ the vast majority of workers, often can't handle the compliance and complexity cost of reporting. So they may not be included in some of these ESG baskets. So it kind of leaves these high margin technology and healthcare companies in the ESG spotlight. The other thing is ESG and tax. So this is from my friend Vincent Deluard at StoneX Macro. He analyzed the companies with the highest ESG ratings and looked at their effective tax rate. And there's actually nearly a perfect inverse correlation. So the higher your ESG rating, the lower your effective tax rate. And only 5 of the MSCI's, nearly 2,000 ESG metrics are related to taxes. So that's, something else to consider. And then also a lot of the ESG names that we just looked at are in highly concentrated industries where I've already talked about all of the implications of why that might be problematic. So, this is, of course, because we're living in the age of asset management with a lot of passive investment vehicles. And what's interesting now is you have, oligopolistic companies that are now owned by oligopolistic shareholders. You've got the big 3 asset managers: BlackRock, Vanguard, State Street, managing over 15 trillion, and 3/4 of US GDP. 82% of all assets flowing into investment funds, have gone to the big 3. They own on average 22% of the typical S&P company. And so, there's kind of 3 main concerns with this. One is the common ownership and horizontal ownership and how that may affect competitive dynamics. The jury is kind of out on that. There's mixed research. But what's interesting is if in 1980, if you paired any two random firms together, more than 75% of them would have no common owner. By 2012, only 8% of firm pairings had no common owner. And I can imagine, that was a decade ago. So I imagine it's gone down even more. So horizontal shareholding is also illegal under the Clayton Act, but obviously nobody enforces it because market dynamics have changed and we're not really sure what to do about it. And there has been some evidence that common ownership also is correlated with higher markups. So when companies have more common owners, they may be disincentivized to compete directly and rather incentivized for the industry to do well overall. And so, they may just decide to sort of tacitly collude to raise prices in the industry. The other thing is, there's investors may be concerned about systemic risk from market distortions that this causes. So the consolidation of index funds could impair efficient price finding on equity markets. As the proportion of actively traded shares shrinks, there might be less diversification, which leads to capital going to fewer companies. That pushes up valuations. And then there's herding and more correlated movements in markets, which could intensify the sort of pro-cyclicality of financial markets. And then lastly, the third thing that people worry about with this is just the market power of those firms themselves and the amount of influence that they have in the economy. And, simply because these are sort of passive funds, it doesn't mean that their influence is passive. It's actually very active. You've got Larry Fink up there, sort of actively threatening companies with things that some of us may agree with, some of us may not, but certainly there are now a lot of conservative critiques which are concerned about the influence that these actors have, and that they are sort of pushing companies to become more woke and things like that. And I think this is really interesting because I was going to say, Bogle himself was concerned about the rise of passive, and I just think this quote is fantastic. Right before he died, he was sort of concerned about the beast that he himself had created. But back to the conservative critiques, what's interesting about them is that they really echo Milton Friedman's earlier concerns and critiques. I also realize it's 8:40 already. Okay, I'm going to speed this up. So, the Free Enterprise Project, it's self-described as the nation's leading program for confronting liberal shareholder activism. It's advised, conservative investors how to vote against corporate wokeness. And these are similar to Friedman's concerns, where he said, companies should should focus on profits, because if they include anything else in their considerations, they're going to become really powerful arbiters of political life. And it's better if companies just make profit and then their employees and presumably the public, through the taxes that it pays, can decide. They can democratically decide where they want the proceeds to go. But I think what conservatives fail to realize is that the zealous application of Friedman's doctrine, this kind of single-minded focus on profits above all else, basically led to a corporation that was elevated to such a high political stature when we undermined any sort of regulatory guardrails on firms, that it basically created the outcome they didn't want, which was that corporations are the most powerful arbiters of political life today. And that's undermined the countervailing mechanisms of the state and the polity. Okay, shareholder resolutions going up, which is good. So I guess I'll just end here. So in the paper, we predominantly are advocating that stakeholder capitalists embrace some of the anti-monopoly policy platforms and solutions. And so we outline 8 different things that they can adopt. Mainly, it's sort of don't actively oppose the FTC, especially now that it's under new leadership and actually trying for the first time in 40 years in a concerted way to take on corporate power seriously, is revising the merger guidelines, this is fantastic. Last time that the FTC revised the merger guidelines and they asked for public comment, they had, guess how many comments they had? 32. Yeah, 32. And they were from economists and, policy wonks and basically nobody from the public. The American Economic Liberties Project has really tried hard to engage the public in this process and demonstrate how important it is. They now have nearly 6,000 comments from people who have written in saying, this is how I've been affected by mergers. I really want you to investigate this industry. This has been problematic for me, or hey, I love mergers, or whatever, whatever people want to say. But there's much more of a democratic process happening. And so this is a great thing. And those who support stakeholder capitalism, those who consider themselves ESG investors or whatever, I think should be publicly championing what's happening there. The other thing is contract terms. I didn't have time to go into this, but there's so many now sort of take it or leave it, or they're known as contracts of adhesion, where workers or suppliers are forced into agreements where they sort of just, it's like they have to take these contract terms, and they may be things like, perpetual claims on IP or non-disclosure or non-disparagement clauses, things that, they're not necessarily illegal, but they certainly have power asymmetries. And anyway, there's like a long list of them. I can also link to it. We have a document. So those I think are really problematic and deserve more attention. There's some really cool stuff happening at the state level. And then broadly, just we need more research on the role of mergers and acquisitions, particularly, as someone mentioned, in the private equity industry, how 70% of private equity deals are now add-ons. So how do these strategies pose harms potentially to stakeholder groups and fair markets? And I wanted to conclude with this quote from Franklin Roosevelt. The first truth is that the liberty of a democracy is not safe if the people tolerate the growth of private power to a point where it becomes stronger than the democratic state itself. That, in its essence, is fascism. Ownership of government by an individual, by a group, or by any other controlling private power. Among us today, a concentration of private power without equal in history is growing. And we could say the same thing today. I will leave it there. Thank you so much for having me.
Thanks, Denise. This is incredible, and it's a lot of information. So I'll probably have some really good questions in a couple of days. But in the interest of the 15 minutes we have now, first of all, I want to encourage people to continue to ask questions in the chat. I want to share an observation as a European or someone who was born in Europe. When I was studying economics in the 90s, pre major globalization, one thing that people pointed out was that there were basically two models of capitalism. The Anglo-Saxon one and the I forget what the other one was called, but it was basically Germany and Japan type model, right? And the American one and the British one was described as arm's length capitalism, meaning you had a lot of firms, lots of investment opportunities, and you didn't have a clique running the economy. And then people extol the virtue of that because it was a way to avoid collusion and the defense of particular interest and so on. And then this market was more equity driven, whereas the Japanese or German model was kind of more debts driven, and then everyone else fell in between. And what's really interesting is that you push this model to the extreme, and 30 or 40 years later, what you see is that this whole arm's length model is falling apart. Right? I mean, between firms that have been taken private, the concentration of power. I mean, pretty much every single one of the points that you made. It's sort of if America is a country of is an experience, then it's pushed an experience to a certain extreme, and it's shown its limits. It is showing its limits right now with consequences for workers, for consumers, for the environment, and so on and so forth. So that's it. That's the tweet.
Yeah.
But I'm really,
Thank you.
I'm really struck by this. So
should I stop my screen share and then we can all see each other? Would that be good?
Sure.
Okay.
Let's do that.
Okay.
So So I guess I'm gonna go back to the chat now to look for some of the questions here. Here, Keith Johnson, how important is the combination of short-term pressure from Wall Street as a contributor to causing some of the effects associated with concentration of power in fewer companies?
Yeah, thanks, Keith. I think obviously that is a major factor. And I think when people say, okay, we want to make sure companies are thinking more long-term, I generally agree with that statement. I think that would be good for us to think, in years or even generations. But I also worry that when we sort of just say that, it's a little too simplistic, because if you look at investors now, like Wall Street, Wall Street had very long-term objectives when it continued to subsidize Amazon for 20 years when it was unprofitable, right? But they knew that over time, over the course of those 20 years, it was building moats in such a way that it would eventually have a winner-take-all dynamic. So I don't think long-term in and of itself is enough to sort of fix these problems that we have. And now like 80% of companies that went public in 2020 were unprofitable, and is for similar reasons, because people are sort of trusting that over time the kind of competitive moats that they can build will eventually give them market power to be able to extract profit in different ways. So I think it's important. I think it needs to be coupled with some of the other things that we're talking about here.
Thank you. There's another set of...
Keith, would you like to respond? I see you came off mute. Sorry.
Oh, not so much respond as just to say that I don't think it's an either or kind of question. I think that they're both contributors, and solving one of them is just not enough.
Yeah, absolutely. No, I completely agree. Thank you. Great question.
Here's another question in the chat from Greg. Denise, thank you. Wonderful presentation. Have you looked at levels of collaboration between large and small companies? It's a key driver of innovation, especially in deep tech, i.e. not digital.
Yeah, Greg, where are you? Oh, there you are. Levels of collaboration. I don't exactly know what you mean by that, but I have been thinking about, there's actually a really interesting new paper by David Sloan Wilson, who's an evolutionary biologist and an economist, and they talk about how this idea that competition is our main driver, evolutionary driver, is not true. They talk about how competition beats altruism when it's a one-on-one competition between people, but actually when you go one level up to social organizations, when groups collaborate, it actually beats competition every time. And that the reason that we've been so successful as a species is our collaboration versus our competition. And so I think that I'm really interested in this dynamic actually between competition and collaboration, because clearly capitalism and like the economic system that we have is one of the most collaborative things we've ever done as a species. And yet collaboration also can be problematic when it's in a cartel dynamic. So I don't actually have a good answer, but I'm curious to hear more about what you're thinking.
We had David Sloan Wilson on our podcast with Allison back in the fall, and I can really also only encourage people to check his work. There is
vaccine development. I see.
Are you?
Sorry, yeah, Greg's just adding his thoughts here. Yes, I mean, yeah, this gets into a lot of, obviously more collaboration there I think would be useful. I would also have liked if it was open sourced versus, maintained, if the collaboration was basically to continue to establish the moat and then have these enormous revenue streams anyway, that's like a longer conversation, but yeah, I don't know. That's a hard one.
There's an observation from George Kitchen. You mentioned entrepreneurship rates are down, but it seems to me that we, certainly in the US and UK, have a real admiration of the entrepreneur. At the same time, we have a lot of can't say this, too many syllables, oligopolistic companies.
Oligopolistic.
Thank
Yeah.
you. It's easier in French because you always stress the last syllable.
Yeah.
Supported by historically low interest rates until recently, and I'd be interested to hear your thoughts. George, since you're here, feel free to develop, or Denise, respond.
Yeah, I wrote it quite quickly, but it does, I don't have any clear data to back this up, but it does feel like there is a real cultural admiration of risk takers and entrepreneurs, and yet there is a real, there is kind of supported, there's less incentive to take risk in both the UK and the US. And when I'm talking about oligopolistic companies, I think it's 20% in the UK of companies are zombie companies. They make less than they make less money than they can use to pay off their debt. It's definitely higher in the US. So they are supported by low interest rates. So that to me seems like edging towards a solution. If it was easier to take risk and follow an entrepreneurial path, then there would be more competition.
Yeah, I mean, no, I agree. I mean, I think it's, you know, I think it's like a forest where you kind of have to have all the right ingredients going. The soil has to be healthy. There has to be enough sunshine. There can't be too many redwoods, or, you know, you're never going to get off the ground. So I think there's a lot of ways to spur entrepreneurship. And I do agree that we generally have this kind of cultural myth of like the hero entrepreneur. You know, he's usually like a lone white male sitting in a garage somewhere that has some stroke of genius. You know, and I push back on that a little bit, because I think we tend to think that those are the value creators in the economy. I think that the value creators are often, you know, the teams and teams of workers who have made an idea come to market. They are the caretakers and the people, you know, who work in the care economy, such that like you can have any kind of productive economic activity. So I would like to reframe who the value makers are in the economy away from this kind of idea that it's like the lone entrepreneur genius, because nothing is created in a vacuum. And often the largest innovations also have been publicly funded. Mariana Mazzucato has done great work there showing like, you know, that actually the risk taker, a lot of time the risk takers actually are public institutions who have funneled a lot of R&D money into getting particular technologies to market. So it's a good question. I think it's, yeah, there's a lot to unpack there for sure. Somebody was saying, I'm sorry, Matt, it's like, can we have some solutions, please?
Can I extend that question, Denise? Yeah. Because I think it's, there's an interesting link to make between solutions and the carrier of the solution and the advocate for the solution. You know, in a complex system, who's empowered to advocate for what sort of change? And it goes through the, you know, you made a number of recommendations linked to regulatory developments in the US, but then who's well positioned to advocate for that in terms of, you know, is it the companies, is it the investors, is it the public, and how does it all play together?
Yeah, I mean, I think, you know, I think something we're trying to do with this paper, which is fairly simple, and it's not like we're the first to observe this, but there has been 40 years of neoliberalism, which has, you know, basically what Milton Friedman did with corporate governance. He was contemporaries with another guy named Robert Bork at the Chicago School, and he did the exact same thing with antitrust enforcement, where he said, oh, actually, government needs to get out of the way and actually just let firms be efficient, and mergers are efficient, and so we shouldn't question it. And so they both have a shared sort of genealogy, the antitrust, like legal antitrust scholarship over the last 40 years, and then sort of economic theory that is both rooted in this neoliberalist idea that the less government interference you have, you know, that markets should just be free to do their thing, and that's the most effective way of organizing society. And what we're trying to say is that, you know, both corporations and markets are public creations governed by democratically, socially created rules. You don't have to live in an advanced economy. Any kind of exchange you do, there's a social contract that we've created as humans that governs the exchange that happens. And when you abdicate rulemaking away from democratic process and public institutions, you basically leave a vacuum where the largest corporations are going to, you know, write the rules in their own favor. And so it's a narrative play to say, like, it's all well and good for us to ask companies to be better corporate citizens, but you know, underneath all of this is the algorithm that drives markets, and that algorithm is maximizing shareholder profit, and that's not changing anytime soon, because all of the capital owners and institutional asset owners reinforce that all the way through the capital markets stack. And so, one, you do need regulators to provide guardrails, and then two, like, that's where I sort of do some of my writing with embodied economics, and I want my next book to be exploring how we might rethink economic value altogether, because we need to fundamentally change that underlying market algorithm if we want to make the system goals and incentives any different. So I do think that the public has a really important role to play here. I think investors also have an important role to play, but I do think that you know, that ultimately the incentives that investors have will sometimes be in tension with stakeholder goals and with public goals. And we can't pretend that every situation is going to be a win-win. Like, we just can't, you know, that that narrative is way too simplistic for the world that we live in. And I think it's highly problematic. So I think there are lots of things investors can do, but I also think that we need to get more honest about the kind of trade-offs that happen in that process.
Yes, there's something about power sharing, right? So we're coming to an end, and there's a couple of strands of questions that I hope we can touch in a summarized form. One is a question again from George Kitchen about whether there's countries or regions that are doing well on minimizing monopoly power. And then there's also a couple of questions about about climate and the environment. And which maybe we can summarize by saying, like, how does this monopoly power affect action on climate change?
You're giving me no time to answer. I don't know.
Take your time. Take your time.
No, that's okay. It's an area that the anti-monopolists actually haven't done a lot of work on. I think the stakeholder capitalism movement is stronger here, also on racial equity. But I think, you know, it's clear that, like, again, you know, some of the dominant firms suppressed climate change research for many years and things, and they've, like, actively opposed regulatory intervention that would have perhaps sped up the process of getting us to cleaner energy. So these things definitely go hand in hand. And there's a lot of work to do here. You know, there's not one solution set, but I think, you know, everyone that's in this room is in a particular position of authority to tackle one piece of this, and hopefully in all of our threads, they weave together into, you know, the world where we want to see. So.
Well, and I hope that this is, you know, an opening conversation to contribute to having more conversations between the people who are looking at these fundamental economic organization questions and the stakeholder ESG sustainability universe. Back to the other question, any regions or countries that you think do well on minimizing monopoly power? Which is kind of hard, right? Because the monopolies are in the US.
Well, they are everywhere,
yeah.
But, you know, strangely, China has taken on their tech firms in a pretty major way, as well as the Europeans, of course, are better than us at most everything. And they actually have, like, a functional, the EU Commission has done a lot of work here. They also have, they have an interesting federated approach similar to the US, where, like, they have a EU Commission that takes on antitrust cases, and they also have national competition authorities at the national level. And in the US, we have the federal and the state level, and sort of, I think the combination of those two things is powerful. So yeah, I mean, again, I think this is going to continually be a problem unless we kind of fix some of those larger system incentive problems. But I do think that the Europeans are at least they're taking some big risky moves with the Digital Market Acts and, you know, other things like that to try to figure out how to better provide these market guardrails.
Thank you, Denise. We've come to time, so we're going to have to stop this now. But I'm grateful for your work on this and your engagement in this event and your engagements with the participants. We'll distribute the slides and a recording ultimately. So bear with us on this. Continue this conversation.
Thank you so much. Please feel free to contact me anywhere online. I'd be happy to continue the dialogue as well. Thank you. Take care, everyone.
Thank you. Bye-bye.